It's Paul Norman here, editor of CoStar News. Just here with Max James, Chief Executive of Quintain. We're here at Wembley, Quintain's major regeneration project. And congratulations, Max, on today's results, full year results, which show seemingly everything moving in the right direction. Profits up, or return to profits, net asset value increasing, and the deleveraging program going to plan, and the balance sheet looking perhaps stronger than even you were suggesting a year ago.
Yes.
It would do so. I wonder if I could ask you about the major milestones as you see them this year.
Thanks, Bob. Yeah. I mean, in a sense, today's results are the fruition of 2 years worth of hard work. We set out a pretty clear strategy about 2 years ago to make sure that we could deleverage the company. Essentially, we had some great assets. We needed the right finance in place to unlock the value within those. So yes, we've delevered, we've focused on London, and actually I think what you're seeing today at Wembley is in a sense that delivery program really coming to fruition. So that's been expressed in net asset value up, but it was also, as you said, the first time we've been in profit since the beginning of the credit crisis. So I have to say we're feeling pretty good about life today.
And that, just going to the deleveraging program and the strength of the balance sheet, in part was the decision with Greenwich, and you've taken the decision now to realise that asset. What you have there.
Well, that in a sense was part of a broader trajectory of selling assets where either they were non-core or we could realise the capital or profits inherent in that. So I think that we have, in a sense, there were two portfolios which we were looking to realise value from. The opportunity with Greenwich came having first brought in Night Dragon about 2 years ago now, and that really, I think, was probably the kickstart of our repositioning of Quintain. That meant that we could get on and not only develop at Wembley, but make sure that we had real traction at Greenwich. But ultimately, last November, the opportunity came for us to sell our 40% interest in Greenwich to Night Dragon, and what that did is materially change the balance sheet. So we suddenly went from about sort of £400 million worth of debt to 200. Now we've obviously continued that with the recent announcement of the sale of IQ, other sales, but I think it was one of those step changes where, having created the value through the planning gains that we'd achieved, there was an opportunity for our shareholders to crystallise that. Greenwich continues to perform well and has been developed well with Night Dragon, but then we can put our full firepower into Wembley Park and also begin to look at the London portfolio.
And just to ask you that about the sale of non-core assets, I mean, has that happened ahead of programme? Obviously, you mentioned the very latest one with IQ.
Yeah.
But, there's not really much work to do left on that.
No, I mean, in a sense, IQ was the fruition of that. But again, I would put IQ in the context of a high-quality asset where our joint venture partner ultimately would look to acquire that interest once we really maximise the value. So from our perspective, you've had strategic disposals, but also the non-core disposals probably came to their fruition with the disposal of the Sequel portfolio last September to Palace Capital.
And obviously you mentioned as well that the focus now in part is Wembley, of course, and recycling that capital into Wembley. Just to quickly ask you, one of the things that people are interested in is how the housing is performing at Wembley, in particular the market, just how that's going at the moment.
Yeah, well, as you can see from today's statement, we have undertaken some sales and hugely encouraged by not only the volumes but the prices that we've achieved. So we took 74 homes to market in our new development called Emerald Gardens. I'm delighted they've all sold, and we've achieved sales prices of between 300,000 to 400,000 for sort of 1 to 2 beds, but that translates back to an average sales price of around about £570 a square foot, which, having built up and the markets had anticipated at £500 a square foot success to have been achieved, we're delighted that it's so much further than that.
And where else can we expect now? Obviously, we've seen the retail outlet centre open during the period. What's the next stages at Wembley in terms of the investment programme?
Well, we wanted, really, as part of our initial development, to complete the leisure and retail destination that really we built around the Hilton Hotel we're in at the moment. So that's the LDO. It's also Wembley Arena, where AEG are now in. So essentially we wanted to build that critical mass, spend money on public realm and really create the platform to then take the residential forward. Our thrust going forward, at least for the next 2 or 3 years, is really to emphasise residential development, but to do so both through for sale. So our joint venture with Keystone, which we announced in March, allows us to really drive that forward, but critically also to retain purely 100% on Quintain's balance sheet some private rental units. So we've held back from that development 143 units, and that gives us another means of creating value, but also some recurring income streams up at Wembley. So I think increasingly we are seeing Wembley having gone from largely a land bank and a development play to being something where we've got the development upside, but also investment assets, which obviously throw off income.
And that area is another area that you're obviously excited in private rental. We can expect that to grow that side of the business.
Yeah. I mean, in a sense, it's the second part of our activities in the private rental space. Historically, we've held around about 150 units at Wembley, albeit other people own the units. We've managed those for people. And what we found is not only are we getting some very good returns from those, but actually the occupancy rates are phenomenally high. I mean, we're getting to 97-98% occupancy, which essentially says there's a pipeline of people wanting to take them. What we want to do is now evolve that into a fully designed for rental proposition. A number of people are talking about it near London, but because of the scale of the development, we can bring it forward en masse. So as I said, we're bringing forward 143. We see the potential to do up to a third of this site as private rental. So that could get you into sort of 1,000 plus.
Yeah, how many homes would that be?
Well, we've got consent over the whole site for 5,000 new homes. So we're starting to develop out 475 of those in Emerald Gardens. So you can see that there's a huge volume. So we're about, even after completing Emerald Gardens, there's another 82% of our pipeline to come.
And the other part of the strategy clearly has been, and we've seen the first couple of acquisitions, has been to focus on central London,
yes.
Central London offices, and also the relationship you have with Wellput. What's the thinking behind that part, and what are we likely to see you investing in going forward?
Well, in part, it's us seeking to create additional balance in the portfolio, by which I mean, at the moment, Wembley Park represents a large part of our assets, particularly after the IQ disposal. Going forward, what we really want to do is to leverage our skill set that we've got both at Wembley Park and also through the team that we've created over the last few years at Quintain, to leverage that to then identify assets within a broader definition of London, where we can add value but also derive some income streams. So typically we'll be looking for assets which are either fully let or where we can work through the assets and lease them up and grow the rental streams, but also where either in the short term, mid term, or in a couple of instances in the longer term, there's a significant development play. That allows us to then add incremental value to the assets and gives higher returns than you might normally get from just a straightforward investment in a standing investment.
And of course that's particularly difficult to source at the moment as well, those kind of assets.
Yeah, that having been said, I mean we're seeing value where one is prepared to step outside the normal constraints maybe of a classic investment that an institution or sometimes a property company would make. So if you're prepared to take on board shorter leasehold structures or where there's a greater component of development required, we've identified and hopefully we'll continue to identify assets of that type where we can invest. But I acknowledge the point that there's a lot of capital seeking a home in London, domestic and international, and it's challenging to find those investments. So, rather we are saying we're looking for them, we're identifying them, but we're being fairly cautious in terms of the relative pricing of some of these assets.
Okay, well thanks very much for talking to us, mate.
That's all.